I converted my whole TFSA into X equity solely because I never had a foundation before. You and Carr and the other all-in-one funder guys gave me confidence. I'm like, if Mo can have $1 million in basically one ticker and be comfortable riding that to the end, why can't I? I have a credit card for everything. If I shop at Canadian Tire, I use the Canadian Tire World Elite. My other favorite card is the Neo World Elite MasterCard. If anybody's looking into cashback cards, this one is pretty dope. I've learned to be a little bit more open-minded. I am still rather stubborn. I've learned to accept other people's viewpoints. Build your foundation first with a low-cost index fund. And then once you're comfortable with the volatility of that, if you want to start getting into the single stock stuff, start researching how to find good ones. Just stay disciplined and make investing a bigger priority in your life, and you'll see great success with it.
I'm excited to be welcoming today Jamie to our show.
Well, thank you for having me, Mo. It's a pleasure to be invited to your show.
For those who may not know you as well from Blossom, Jamie, why don't you give us a quick introduction of who you are, and we'll go from there.
I am 40 years old. I was born in Cobourg, Ontario, raised in Cornwall, Ontario. I did most of my adult working career in Hamilton, Ontario. I traveled back and forth from Cornwall to Hamilton every week for the first 10 years of my working career. Every Sunday night I'd drive to Hamilton. Every Thursday night I'd drive home. And
Wow. How long of a drive was it?
it's about 5 hours if there's no traffic.
Oh, wow. It's quite a bit of a
Sometimes
drive.
7 or 8 hours if there is traffic. So I've been working for the same company for 18 years now. I started there when I was 23, 22. I don't remember exactly now. So it's almost my first job, but not quite. I've been there a really long time. We ended up getting a contract in Calgary, Alberta. So we would do fly-ins and fly-outs. I'd be out here for 14 days and go home for 4, and then fly out here for 7 days and go home for 2. It's whatever the company wanted, basically.
The schedule might have been.
I met my wife at a hotel that we booked to stay in for work. And then after the pilot project was done, the company landed an actual full-on contract. And they were looking to expand out west, and they asked me if I would like the opportunity, and it was working out with my now wife relationship-wise. So I said, sure, let's do it. So we, the first year, because it was a new relationship, I wasn't quite sure. We continued the Ontario people working in Alberta, and I decided to move in with my wife and her brother in their rental property, and the company would fly the other guys in and out, and then I would stay there. And then eventually they hired local guys, and they asked me how it was working out, and I said it's working out really well. I can make this permanent. So they gave me a relocation allowance. I flew back to Ontario for Christmas break, loaded up everything that was in my house in a U-Haul trailer, and she flew down with me, and we made the drive from Ontario to Alberta, put all their stuff in her basement, lived with her and her brother for another year in their rental, and then we bought our own home, and now we live happily together, minus the brother.
That's quite a journey for sure. And then that drive even from Ontario to Alberta, I would imagine it's probably 20 plus hours at least.
I think it's 36 hours, if I remember.
Wow.
It takes 4 days in a commercial vehicle because of logbooks and stuff.
Yeah. And you can't rush it either, right? So that's amazing. And then, Jamie, when did you start investing in the stock market? Because I've seen you on Blossom, but I'm curious, did you start investing a while back, or was it a more recent phenomenon? Tell us more.
I started investing actually when I was really young, 16 or 17. I mentioned on Ari's podcast. It was, I forget what book I read, but it was about dividend reinvestment investing. So basically back then there was an online forum. You could buy a share certificate, and it was really honor system. You would contact the guy on the forum. You'd say, hey, I'd like to buy your share of, let's say, Bank of Nova Scotia. And he's like, sure. The share price is $100. You transfer him $100 or put $100 bill in an envelope and mail it to him, plus the the registering fee or whatever. And he would sign the share certificate over to you and get a new share certificate ordered, and they'd mail the share certificate to you, and then you'd register it for drip plan. There's no commission fees or anything. And then
Mhm.
it just gets dividends reinvested without a brokerage account. I don't even think you can even do it anymore. Probably most people don't even know what it
Yeah,
is.
times have changed.
But I have
Yeah.
probably, I don't know, 10 or so different ones that have just been on drip for 20 years. I don't even know how much they're worth anymore.
Especially, I think some of these dividend pairs, especially for a longer period of time, I think, assuming you don't add anything new to it per se, the yield on cost is gonna just be so much higher. So that's definitely nice to see. I know dividends. It seems like at least during that journey that I've followed you on Blossom, dividend and essentially the income, the cash flow, however you want to call it, seem to be a big piece for your investment for investment philosophy. I also saw recently that you've made some switches, slightly. It seems like it's slightly dabbling into different way of looking at investment too. It's not just purely the dividend or income. Do you mind elaborating on that? What made the switch? What got you into covered calls? What made you balance it out a little bit more? Love to know more.
So basically, um, I touched on a little of this in a couple of posts on Blossom. My earlier years, I wasn't very financially savvy. I was a little bit more financially illiterate back then. I didn't know the implications of my actions. I got into a lot of credit card debt and whatnot. Fighting through that, we had issues with finances, especially when we had kids, because I didn't realize how expensive that was going to be. So basically, I was carrying quite a bit of debt when I joined Blossom. I joined in October 2023 and was just browsing through people's profiles. And I stumbled upon Perry, who you've had on your show, with his
Mhm.
spreadsheet tracking every little thing. And I'm like, holy crap, you can get 20 grand a month in dividends from what? How big is your portfolio? And I realized it was like $1 million portfolio. And I'm like, that's still pretty freaking good. Like, so I'm like,
Percentage wise, yeah.
what kind of investments is he doing to do that? So I started looking into covered call ETFs and stuff. I reached out to Perry in an email thread or in a comment thread on one of his posts with my email. Hey Perry, would you mind talking to me for a couple minutes? I got an issue if you can help me try to navigate
Mhm.
what I should do. He didn't give me specific tickers or any recommendations on what to buy. How I was brought up, my parents they didn't talk about finances at all. It was always debt is bad. If you have to take money from your RSP to pay off debt, then you're getting an automatic 19% return because you wiped out the debt, and then you can let the rest of it grow. So I did that a few times earlier on in my life. That is probably the worst advice I could give anybody. Do not ever take money out of your RSP for anything unless you absolutely need it. Probably the only reason would be to buy a house because you're allowed to actually pay it back that
Mhm.
way. So I did that a few times, and then I had an income problem because I was irresponsible. So it happened again, and it was amplified by having kids and a brother-in-law that wasn't really helping out. So I reached out to Perry. He guided me through his investments, how he chooses them. He has evolved quite a bit since back then as well. He didn't have
Mhm.
all his buckets he had now spread out. He had significantly lower yielding investments back then. But he told me how he picks his stuff. And then April 2024, my mom flew out to visit and she brought me a check from my grandmother that passed away 4 years prior via my aunt's inheritance. And the note in it said, I have more than enough money. Please use this to make your life better.
Mhm.
I'm like, holy shit. Okay. I have
Mhm.
like 60 grand of debt and I have a $60,000 portfolio. Do I take the 15 grand like I always have and put it toward the debt and have 45 grand that I still have to fight to pay off? Or do I invest the 15 grand into covered call ETFs and then use the distributions to pay my debt? So basically that's what I did. Back then I started off really, really small. I only took the initial 15 grand. I split it up between the 5 highest yielding yield maxes at the time. So I don't know if you're allowed to mention tickers on the show, but
You could mention if you like, but of course, if you mention it, we are not providing any financial advice. It was more so for your own journey, what you chose at the time, and you're probably going to share as well what ended up happening for you at the time. And markets have the differences. Past performance is not a guarantee for future
and
either.
that is absolutely true after last year.
That's true. We all saw that.
All right. So early on, I chose the 5 highest yielding yield maxes at the time. So I had Coney, NVDY, TSLY, ULTY, and MSTY. So I chose those solely based on the yield. And then I downloaded stock events, and I said if I invested my 15 grand at inception, split between these three, how much money would I have? Would I be ahead or would I be behind? So I did that. I wrote it down on paper. Every distribution received, invested back into whichever one I chose or the same one. And I was up like 30-40% on paper. So I'm like, oh, it's a lot better than 19% credit card debts. I'm just going to freaking do it. So then I actually split the money up between those 5. I was really reckless on not focusing on debt. So I'll be very clear on that. I would take all of the debts I had. I would only pay the minimum payment, nothing more. Everything else was reinvested into building more cash flow. So I did that. Started in April. I got like $860 worth of distributions. And then I got pretty hooked to it really fast. So then I started converting more and more of my portfolio. So then I dipped into my original 60 grand. I think I had 35 in my TFSA and 25 in my RSP. I put the 15 in the TFSA because I wanted to withdraw the money. So I ended up with 50 in my TFSA and 25 in my RSP. So I converted my TFSA first slowly, and then I think I was getting $1,300 a month by month 3 of doing it, and then $1,600 a month by month 4, and then 17, 18, 2 grand. And then, I don't know, 5 or 6 months in, I converted the whole 75 grand into it, 100% all in, both accounts. I don't know why I did the RSP because I didn't plan on withdrawing it. It was working for me, so I did it. Anyway, I converted the whole shebang. I went the whole year just paying the minimums, knowing that my mortgage was up for renewal in 2025. Converted the whole thing, paid just the minimums, and then I gave myself an end date. I'm just going to sell whatever's left over. Everything must go, and then pay the rest of the debts. So that's basically what I did. And I wiped out all the debt, and I still had the majority of what I had invested already. And then I just restarted the process again.
So your goal essentially was invest, grow that money beyond what it's worth, and then use the proceeds to pay off the debt. And in the meantime, still have your original investment. It did seem to work out at the time for you, for your portfolio and for your approach. So what changed then from there? Why did you then switch back?
So basically what changed between then and now is the total return profile back then, like Misty from inception to when I fire sold it was over 200 some percent. So the timing of it was completely pure luck. If I tried this exact same thing starting in 2025, I would have freaking probably lost everything. So the timing of it is what made it work. I think what saved my account back then is I wasn't necessarily dripping into the same fund that the money was coming from, so I wasn't stuck in the same position. Back then I had at my peak of it, I ended up having, I would say probably $130,000 or $140,000 worth before I fire sold what I needed to, but I had 130 positions. I literally owned almost every single covered call ETF that there was. My goal back then was to get paid every single trading day the stock market was open. So I would get a distribution. I'm like, okay, what pays next? So I would buy it. Okay, what pays next? So I'd buy it, make the minimum payment on the credit card. What do I have left? How much does this yield? Buy it. And then I grew that snowball so fast. and then fire sold what I needed to, and then tried building it again. What changed in 2025 was I didn't need the income anymore. And Carr and I went through this on my using income positions to pay off debt thing, or not debt, but use it to pay a bill. So basically, what I think happened was this was working so well for me. I was putting more of my own money in the market at the same time, and that was having more of an impact than paying my debts. So I was growing it psychologically. I did a huge psyop on myself psychologically, but I was investing even more money and grew that snowball even bigger because I wasn't worried about the debt I had. At my peak, I had my best month, I think I had $1,000 in distributions on an account that was less than $150,000. And I thought that was pretty insane. Like, so I wasn't.
In a way, it's like too good to be true. It's kind of thing.
So, yeah. So what happened in 2025 is I wasn't really worried about the income coming in. So I went back to not really contributing as much. I tried to drip the investments into themselves. And then with everything going on with Trump, and don't get me wrong, I don't actually blame him for what's going on. He's doing what he feels like he needs to do to make his country better. It was just not a really fun ride.
Particularly April, like that was like very tough.
Yeah. So basically I was just keeping the funds internally. Back then I was conventionally using my paycheck to pay my bills. I wasn't putting anything in my account. So all the money was just being recycled between all my dividend positions.
Yeah.
Sure, the distributions were increasing, but the NAV wasn't really going up because I wasn't actually putting any more money in. And then I got into, sorry if I'm rambling, finding different YouTubers to follow. This guy on Blossom, Fully Invested Fi. Basically, his deal is he invests all his income up front. He buys 3 different buckets: growth, income, and drip. And then he borrows from margin to pay his bills. And then the idea is like 5 or 6 years, 7 years time, the portfolio will sustain itself without putting new money in. I could borrow $5,000 from margin. My distributions pay 7. I'm a positive of 2. And eventually the idea is the portfolio will sustain itself. And it's very painful to start at the beginning though, because you're borrowing more than you're earning. So you're increasingly going into debt while future you will benefit from it as long as you're comfortable with that and the volatility of it all.
Would you consider their overall a risky approach and not for the faint of heart?
I don't know if I would clarify it as risky per se. It's definitely not for the faint of heart though. So anyway, so yeah, I said, oh, that's a good idea. I have $5,000 a month in distributions. My work income is about $6,000 a month. So let's do that. I will deposit my whole paycheck into my margin account and I'll buy whatever. And then I'll borrow on margin to pay my bills. And I was just, every cent I had, I was just throwing it in the market. So from the first half of 2025, I was conventional and spend my paycheck as normal. I started the paycheck to portfolio thing in June. My whole paycheck, if I have room on my TFSA, it would go there first, and then I would buy something and then go to my margin loan. Okay, my mortgage is $400. My credit card, because I still use my credit cards quite a bit. And what I'll share later will blow your user's mind, I promise. So I'm still using my credit cards. So I would draw, okay, my credit card balance, I have to pay $1,200 on my credit card and $400 for my mortgage. So I would borrow the $1,600 for my margin loan and I'd pay it. As long as I'm in the interest-free grace period on my credit card, it's free money to me. So I did that since June until December 2025. And it's like, this is actually really doing something. I can see how this could work.
For your credit card, you talked about the grace period. So I know sometimes financial institutions, they have this offer like, hey, if you move your credit card debt from one institution to another, they give you this grace period essentially, like up to for a year, maybe you pay very minimal fee or almost sometimes 0%. But their hope, of course, I think is that long term, you still are going to carry on some of those credit card debts and they're going to benefit from it. because they're going to take over from another financial institution. Is that what you talk about the grace period?
No, I'm just talking about on your monthly statement. So
Oh, the time that you have left for paying back?
if you if I bought, say, a phone on my credit card, as long as I
Right.
paid it off before the next statement, I don't have to pay any interest on it. So the interest-free statement on
That's
your
right.
credit
That's
card.
right.
I also use
Gotcha.
balance transfer offers like that as well that you're referring to.
Wow.
And absolutely,
Yeah,
they want
exactly.
you to, oh, I have a 21%, I don't know, $5,000 on this credit.
Yeah.
Absolutely. I'll transfer it to you guys at 0% interest for 9 months. And then they're absolutely hoping that once the 9 months are out, you haven't paid that 5 grand off, so they can charge you their
Hmm.
interest on it. They're stealing from each other's balance sheet, I guess.
Yeah, exactly. Getting each other's business. So you did as well. So maybe I'm gonna ask that question because I saw in your portfolio, and this is it clarifies it a lot. So it seems like you're now focusing on those multi-bucket strategies, so to speak. Sorry, I'm just simplifying it. You said bucket almost for distribution or income. One word more, I think you categorize the growth. I can't recall the other one. Was it margin or borrowing? There's three buckets that you talked about. Is that how XEQT ended up becoming into the mix? And now from your portfolio that is linked to Blossom, I'm not sure if it's the entire thing of it or not, but XEQT did appear to be one of the largest ones. Is that how it came in?
That's not exactly how it came in. Like Perry gave me really good advice back then, but his advice didn't really yield as much for what I wanted to do. So basically, I went all in on all the highest yielding stuff I could find. And then as
Mm-hmm.
I evolved over time, I tried to do the 3 buckets thing, but realistically, I only had 1 bucket. It was ultra high yield. My peak portfolio, I had $65,000 worth in WPay and dollars worth in Ulti. And that was it. That's what I ended up converting it to in the end. And then January of this year hit. That's what I had in my TFSA. I mean, my other accounts, I had smaller Canadian income positions. So I'm going a little bit back and forth. I did dabble with Ulti in my margin account for a month and a half in
Mm-hmm.
July last year. After the RE podcast, I decided to dabble with it. So I took a personal loan and then bought Ulti instead of using my margin account. And then I took the margin loan to pay off the personal loan. So essentially, I bought a U.S. security at 4.45% instead of 7% interest. And then I used the distributions from Ulti to start paying down the margin loan. So I bought it on margin, but technically I didn't buy it on margin in my mind. And then the margin requirement changed and I said, nope, she gone. So then I sold it and then I paid off the margin loan with what was left. I'm like, okay, well, that idea works. It's just the margin requirement will screw me over if I get margin called. But anyway, so
That can be tricky. And in today's world, like if you look at your portfolio, Jamie, so if you were to summarize it, essentially how you look at it, how do you categorize the breakdown as a high level? It doesn't have to be specific holdings, but like, would you say maybe more than half of it is in distribution still, less than that? That's one thing I'm curious about. And maybe that's a nice segue to as well. You touched on the some of the borrowing and margin and all of that. So I want to know more how you approach that. Again, not suggesting everybody goes just go and copycatting anybody else, but this is just we're wanting to learn about how you're approaching and the why behind it more interestingly.
all right, so how I'm approaching it now, we got into January this year. I still had my Alti and WPay positions, and I was like, okay, I know 2025 wasn't all that great nav wise. I didn't really grow anything. Yes, I withdrew probably $30,000 from my margin loan for personal bills from June to December after doing the paycheck to portfolio thing. So that part was working. My margin debt was increasing, but all my credit cards are still zero. So I had a big margin loan, and then the stuff started talking about taking over Greenland and this and that. And then I'm like, no, not again. Not again. I am not doing this again. So I decided I would just freaking fire sale what's left. I'm just going to throw it all on our X equity in my TFSA because I didn't want the U.S. positions in my margin account because of the tax implications of foreign income and stuff. So I converted my whole TFSA into X equity solely because I never had a foundation before. You and Carr and the other all-in-one funder guys gave me confidence. I'm like, if Mo can have $1 million in basically one ticker and be comfortable riding that to the end, why can't I? So I did it solely to use as a foundation. So I went from $6,000 a month in distributions to like $200.
I'm sure that would, psychologically, that would have a huge impact on you. So how did you take that, and how did you have to make peace with it?
So I'm sure you probably saw a couple of my posts on Blossom about how I
Yeah,
was done with CC ETFs and I'm just going to
yeah.
sell shares. Well, that was a mistake. I said I could sell shares. I can't sell shares because as soon as I did it, X equity was down $1,200. And I'm like, damn it, man. So I still had a little bit of a margin loan. It wiped out all the bills I used personally. So I still had probably like $20,000 because I contributed it to my RSP. So when my tax refund comes, I'll get most of that back. So I still have this margin loan. I still don't have any credit card debt. And now I'm focusing on how am I going to pay this margin loan off without any dividends? This is not going to work. I can't.
How big is your margin loan?
Right now, I would tell you if Dave Ramsey ever met me, he would have a heart attack. Right now, currently, my margin loan is at $98,000.
Yeah. And what is the rate on it,
It's
Jamie?
4.45%.
Okay. And then is it, do you often get margin calls or no? What is do you try to, now that you've known about it, do you try to keep a little bit of a cushion so that you're not pushing it to the extreme, so that you're not getting a call? Is that how you do it?
I'm pretty much pushed to the extreme all the time. Well, right now it's at 98,000. Back when I did the switch, it was only at 20,000 or so. So I'm like, how am I going to pay off this $20,000 with X equity? And it's already dropped $1,200 the day after I bought it. Like this isn't going to work. So I immediately borrowed more money. I bought 500 C day and 500 S day, and they give me $180 every 2 weeks between the two of them. And then my margin, I'll just do the math on it. So back then, so I had a $20,000 loan divided by 0.0445. Oh, I did that the wrong way. $20,000 times 0.044445. So the interest would be, it's only $74 a month on $20,000 that I had left. So I'm like, how am I going to pay this $74 a month? I'm paying for things with dividends before, and I want to fully invest my paycheck, but borrow more money. So gradually that interest will increase. So I bought 500 a C day and 500 S day. So that was about.
So for you, Jamie, is that, do you see it as if, like, let's say I'm borrowing to invest, and let's say I'm paying monthly a certain amount of interest on the borrowed amount? Do you, in your mind, do you always see it as if, like, oh, that money has to come from a dividend or some sort of distributions? Is that all how you see it? Because for me, and the reason I say that, I have a Smith maneuver, right? And Smith maneuver is different to some extent, right? But it's still a borrowing from a home equity line of credit, right? Yeah. And I currently capitalize the interest, essentially borrow back from HELOC to pay off its own interest, right? Indirectly, but essentially it is growing and growing and growing. And I think right now the HELOC amount is closer to 72,000, right? The interest, I think my rate is a bit higher, closer to 5%, 4.95%. Right now is around $300 or $2 or so, 300 or so per month. But how I see it, even if I was not capitalizing it, I had in my mind, I would have thought, okay, that's a cost every month as long as I'm comfortable with the amount, because that's how much borrowed, right? Yeah. That I'm going to set aside from my paycheck, because I still have a paycheck, and similar to you, right? So I don't see that, oh, it has necessarily the investment itself has to cover its own costs. You know what I mean? So for me, I made peace with it. But why is it that you think that it has to necessarily be covered? I mean, that's the impression I'm getting. Hence, I'm asking the question that it has to be covered by a distribution. Why can't it be covered by, let's say, a subset of your paycheck that you set aside and just cover it that way?
It's just the framework, how I framed it in my head. I want the distributions to pay for it because I want to invest my full paycheck. Like I literally invest my full paycheck. So if I earn $1,250 that week, I'm buying $1,250 worth of stock. So I want the investments to pay the interest on what I'm borrowing for personal. And even this strategy has evolved since I first started it too. So basically, I wanted the investments to pay the interest but I didn't want the volatility of the ultra high yield stuff, and I didn't want any
Hmm.
US stuff in my margin account. And now my TFSA was maxed, and the only position in it is X equity, so I'm not taking anything from that. That one's gonna ride or die and sit there. Like if a absolute emergency happens and I have to take some, it's just gonna sit there. It's the foundation to the whole system. You need a strong foundation if you're gonna be borrowing money. Taking $20,000 swings each way when I was doing it the other way, it wasn't fun. And then back then, I didn't really even do it on margin. I did it with all my own money.
Mm.
If Yeah, it would have been
Now with margin, of course, is just exasperate the whole circumstance, right? Even I would imagine the thoughts that comes to mind, like, now the portfolio is down, but also not only down, it's also down on the money that I already borrowed
yeah.
to actually invest. So it's just gonna probably have that much more impact and pressure point on you. You said, Jamie, you've been on Blossom for, I think, close to 3 years, if I heard it right. Sorry, did you say you joined last year or did you say 2023? I might have missed this one.
I joined October 2023.
2023. Okay, so more or less, I would say 2.5 years or so far. How much value have you personally got from Blossom? Is it aspects of connections, learnings? Curious to know what do you find most enlightening about Blossom for you?
For me personally, I've learned to be a little bit more open-minded. I am still rather stubborn. I've learned to accept other people's viewpoints and critically think on them a little bit. I still stubbornly chose the same path I was on from 2024 until the beginning of 2025 and brute forced it from 2025 to January 2026. And I'm like, okay, this is a losing strategy after April and everything. And this was majority with my own money still. So I wasn't at risk of margin call. I just had to stomach it and bear down with it. And then at the end of 2025, I started gradually shifting my focus that, hey, maybe this idea doesn't have much longevity to it. And I tried a little bit in January, and like I said, he started with the Greenland stuff. And I'm like, no, I'm not doing it again. So then I switched it up, and then I had to figure out how to pay this margin loan off and still not use my credit cards. So I borrowed more money to buy the C day and the S day so they would pay the interest off while I just thought in my head, what am I going to do? Am I going to go all in one and just let the capital appreciation take care of it? And once I get a couple $1,000s in capital gains, I'll sell some to pay the interest? Or do I keep going with light yielding covered call ETFs or dividend stocks that yield more than 4.45% interest because I'm still borrowing money? So everything I borrow will have an interest charge on it. But everything I invest, if I invest more than I borrow, so if I bought 100 shares of bank for $956 and then I borrow $800, that will cover my interest. So that's how I framed it in my mind. I want whatever I buy to pay the interest on whatever I borrow. Just the interest. That's all I really cared about. So that's what I've been doing.
Yeah, so that's almost like the criteria you're thinking, right? So you want to make sure, at least in your mind, whatever you're buying, in terms of the distributions that it has, it covers that amount required to have been borrowed to be able to buy that in the first place, kind of thing. In other words, break even, and a little bit more possibly, right? At least break even though. That's your criteria, kind of thing. Jamie, what would you say has been your most expensive investing lesson that you've learned over the years?
I have a couple of them I'll share with you. The first one that probably actually costed me the most amount of actual money it wasn't even in the stock market. It was real estate. So I started my job at 22. I bought my first home at 23. It was my primary residence forever. So I would travel back and forth from Hamilton to Cornwall. It was my primary residence forever. So technically, I would be exempt from capital gains when I sold it. That's what you would think. So what happened with that one is that I bought the house, and then once it was working out with my wife, who was my girlfriend at the time, I switched my address to Alberta the last year, and then I rented out my house in Ontario. So I had the top level and the basement level rented out. I was in Alberta working, and I changed my address because I had my youngest brother living upstairs. So technically, I could have still lived in Ontario. So I changed my address to Alberta. And when I went to when I fully made the decision to move out here, my middle
Hmm.
brother asked me, hey, I would like to get a rental property. Would you sell me your house? So I sold it to him. I paid 136,900 for it. I sold it to him for 175. So then I did my taxes that year. I had an accountant do them. And then I got hit with $1,000 freaking capital gains tax bill because it was no longer my primary residence because I changed it to Alberta the last year I owned it. I had the house for 11 years as my primary residence, and then I sold it and changed my address. Well, legally, that's what you're supposed to do. But that one bit me pretty hard.
That can be costly for sure. Wouldn't that be proportional though? Like, like I thought, like let's say if you, let's say owned it for a decade and only it was not a principal resident for 1 year, proportional aspect of it would apply. But I'm not a tax professional, but I just thought at least in my mind that would have been the case. I'm not sure if that was actually the case or not.
That's what I thought as well. I argued with my tax accountant about it. I'm like, it was my primary residence for this long. And then he said, because you rented out both units and changed your address to Alberta, you technically weren't primarily living there. If I had left one
Interesting.
unit empty and left my address there, it would be fine. But since I had both units there, and yeah. So he said it,
It's very interesting.
so that screwed me over. The second one, probably that cost me the most real money. Back when I first started investing, I was looking for dividend stocks. I was blind yield chasing. I just looked for yield. I didn't look for fundamentals. I didn't look at anything. So I stumbled across Zim, which was a shipping company. And they had just paid a $16 or $14 special distribution. And I'm like, holy crap, the yield is 139%. So I borrowed, I think, $3,200 from my line of credit and I bought 100 shares, thinking that I would get that back in less than a year. So shortly after that, the next quarter, they cut their dividend to, I think it was $6 and something. And then they cut it the next quarters to $3 and something. And then they got financial troubles. And then they stopped dividends altogether for a year and a half before they resumed. And then all the while I'm paying interest on my line of credit and I'm not getting dividends anymore. And the share price dropped 85%.
Wow. So you're essentially on the distribution front, you're being impacted also in terms of the value of the portfolio on those investments. They're also going down. It's just, was it during the time that, at some point, I don't know when it was, but like shipping, there was almost like a hype around shipping companies and whatnot. And like there are a lot of people interested. Is that what it was?
No, me,
Is that when you got into it?
this was just a
Yeah,
blind
just
yield chase. Like I wasn't even on Blossom when I did
yielding.
this. I
Yeah.
just went through dividendchannel.com
The list
and
of, yeah.
sorted by dividend yield and said, oh, they just paid $14 a share? All right. But that was
Okay, I
even way
hear you.
before I joined Blossom. So I
Okay,
did
yeah.
that one without having any knowledge at all.
I think, Jamie, I saw somewhere on Blossom you categorize yourself almost being a little bit later to the investment game. You fairly started early though. So if I heard it right, what would you say that? And essentially, if you still think that way, what's your advice to people who they think that maybe they're late to investing?
I classify myself as a late starter because most of my adult life, I would invest like a little bit of money, like the leftovers of my paycheck. I would buy stocks. Like I'm also a little bit contrarian investor too, but I would buy a little bit of Suncor. I'd buy a little bit of this. I'd buy a little bit of that. Whatever my gut told me at the time. And I got lucky on quite a few of them, but it was just luck. I bought a couple gold mining stocks back then that went up 200 or 300%, and I sold them. The contrarian in me, whenever Husky Energy announced 4,000 jobs were being cut in Calgary when I first started working out here, I'm like, oh, that sounds like bad news. So I was thinking to myself, I'm like, this is bad. So I waited a little bit, and then, of course, the share price dropped really, really, really low. So I decided that I don't think Husky's going anywhere. There's gas stations everywhere. What's most likely going to happen in my mind is someone's going to buy them out. So I bought a bunch of
Mm.
shares of Husky when it was pretty much at the bottom. And I just sat on my hands until Synovus acquired them. And then I got those all converted into Synovus shares, plus some Synovus warrants for, I think they're $6 warrants or something like that. So I
Mhm.
got that all converted, and we know what Synovus price right now is, like $27 a share. So that went up 200 or 300%, and I bought Suncor with it, and then I diverged all that around. So I've been investing for a long time. I just didn't really get serious about it because I was just investing the scraps on my paycheck, and I'm already freaking tight. I have credit card debt that I'm paying from my paycheck. But then some months I work construction, so I'd get a cold weather shutdown. So I'm only working 3 days this week instead of 5. So I'd fall behind again and then pay the credit card and fall behind again, pay the credit card, fall behind again. It's not because I had bad spending habits. It's just how it worked out with lifestyle. Like I didn't have an emergency fund. The unexpected stuff started stacking up. So when I joined Blossom, I gained more knowledge and saw the value in investing. So I prioritized it more and then converted what I had built up over 20 some investing years into ultra high yield ETFs and then evolved from there. So my late starting, like I technically didn't start late. I started taking it seriously. My advice would mostly be to know what style you want to be. If you like dividends or if you just want capital appreciation. Do you like stocks? Do you know how to read a balance sheet? Because single stocks, I'll be completely honest, they're not for me. So yeah.
There's a lot that goes into it, right? So if you don't know what you're doing, it would be almost like, okay, well, I guess what people say, almost like when you're trying to read a chart sometimes, like if you don't know what you're doing, it's almost like you flip it on its own, like turn it around, and it looks good without knowing what you're actually looking for and how to interpret that. That can be really tricky. So no, it can't be for everyone, but it could be for some people who are really passionate about it, want to put in the time and effort and really intrigued by it, by all means, of course.
Yes.
That's what you're, I think, talking about, Jamie, right? Everybody can be different. So know themselves best before they dive into it investing,
Yeah.
right?
So yeah, basically know what you want to be, develop a strategy around it. The easiest thing for new investors is an all-in-one fund. You just put money in, and over a long period of time, it will be worth more than what you put into it. And if you want to squeeze out a little bit extra, start learning about how to sell options or single stocks and stuff. But I would say build your foundation first with a low cost index fund. And then once you're comfortable with the volatility of that, if you want to start getting into the single stock stuff, start researching how to find good ones and then just evolve from there.
And gradually also take it from there, right? So gradually see your comfort level. I have a surprise question from the previous one of my previous guests for you, Jamie here. How has your spending habits changed ever since you started investing?
They haven't.
You haven't? Yeah.
They're still the same. Basically, I don't run it.
What would you categorize as your biggest spending categories overall, would you say?
It's basically just general living expenses. Like we don't really do anything. Like basically, I have my house, my mortgage, I have my car loan, which I also pay everything weekly because of amortization. You pay less interest if you pay everything
Yeah.
weekly. So I have my mortgage set to weekly. I got my car loan set to weekly. I've got car insurance is monthly. It's cheaper if you can pay the whole thing yearly. Just so you know, some insurance companies will give you a discount if you pay the whole policy premium up front, which I never had the money for. So that's monthly. And then there's utilities and everything is all monthly. So it's off balanced with my income. So I bridge things with credit cards. Now I'm bridging it with my margin account. So yeah.
Yeah, that's good. And I mean, again, knowing yourself, right? So it's obviously you have chose this path and this approach of investing because you said you're also. Is it because you're essentially taking all of your paycheck and investing it, right? So let's say had you not done that, you probably paycheck would have been enough to cover the bills. Is that fair to say? But you're choosing to invest it, and in order for you then to cover those costs, you're using the margin. Is that fair to say, or trying to at least use the distributions? Is that how I'm categorizing it, right?
I'm trying to Like conventionally, there are some weeks where I end up being cash flow negative.
Uh,
So it's just how all the payments work
it
out,
varies.
like property tax on the first, and
Yeah,
then
that's right.
cold weather shutdown, this, that, the other thing. So it offsets itself. So there's some weeks in the month, especially in the wintertime, where I'm cash flow negative.
Hmm.
So I'm not always cash flow positive. So it's not really a great thing to be in, which is what gets you into debt in the first place. So I figured it was more beneficial to put all of my money in the stock market where I know it'll appreciate over time, whether it's a couple percent or not. So
Hmm.
as long as it appreciates more than I did some simple math with Grok, my favorite best buddy, that if it appreciates at least 7% a year, if I have to sell some for capital gains, then I'm basically broken even. It would be like I didn't invest anything at all. So anything above 7%, I'm making a little bit of money. So I decided
Hmm.
I'm just going to invest everything that comes into me. If I shovel someone's driveway for $20, that gets invested. If my wife, she runs her own little clothing store for
Home
kids or
business,
stuff.
possibly.
If she
Yeah.
has money and she wants to invest it, I started an account, her TFSA up with her money because she wants to save money for taxes because that side business blew up huge for her. So I put all of
Hmm.
her money into Z Equity T because it pays distributions just to try to get her motivated to invest more. So she'll see the notification.
And what is the end goal? Yeah, Jamie, I might have missed to ask question. I think probably I should have asked. So, what's your end goal? So, are you saving and investing for people typically do that for a certain for a bigger purpose, right? So, for example, I might be wanting like, oh, you know what? I want to get to a level whereby I have work optional, or somebody might say, well, you know what? Oh, I just want to change my lifestyle so that I can spend more. Or somebody like, oh, I want to quit my job sooner. What is the big motivation for you to? Because that obviously is a lot of sacrifice as well. You're investing diligently every single month, pretty much every paycheck money that you get, all of it, you're putting it back into the stock market. I'm curious if you can touch on the why.
It's just as I touched on saying that I was a late starter. I I physically didn't see how it was possible for me to invest enough money conventionally to get where I needed to be to retire at 65. Because the way I was going, like it's pretty much paycheck to paycheck if I'm not investing. If I would to stop what I'm doing now and just go back
Hmm.
to paycheck, I don't have anything extra to invest.
To put
So
in.
I'm in my lean years because I have two children, diapers and whatever, and all this stuff, all those
Hmm.
extra expenses. Like I barely have a couple $100 a month at the end of the month.
Yeah.
So if I invested $200 a month into X equity, what would I have? Versus if I invest $6,000 a month in X equity and then borrow the $5,000 a month I need at 4.5%, what would that give me? And in my mind, the cost benefit analysis of that was that I will have significantly more money if I invest the 6 grand a month. So that's what I do.
And you're getting the tax deductibility at the end of the year too for the amount that you're borrowing to invest. Is that something you're looking into as well, Jamie?
Yes, that is what I'm looking into. I've been speaking
Or
to a few other investors on Blossom. I know that borrowing for bills is not tax deductible. So my
Mhm.
workaround for that was that I would just estimate January is usually a lean month. I'll probably earn
Mhm.
$4,500 this month. So at the beginning of the month, I would front run my income. I'd invest income I haven't earned yet. So I'm borrowing it. Well, I am borrowing
Mhm.
it. So I would front run my income. So I would buy $4,500 worth of bank or
Yeah. Income producing
HSIP
asset or something that has potential for income.
or
Yeah.
C day or S day or Q day or whatever. As long as it paid more than 4.45%, I would invest that up front. Lower marginable securities are better for what I'm doing. The majority of my positions right now are 50% margin requirement. So it's holding me back a little bit. So basically how the margin requirement works, if you want to borrow money to invest, I'm going to use XMD for an example. It is only 20% margin requirement. It's like small and mid cap Canadian companies, if I remember correctly. I started off in that in January. That's where I would put my paycheck. I would invest it in XMND because it was 20% margin requirement. It didn't yield more than 4%, but I knew it would capitally appreciate more than 4.45%. So I invest my money there. I invest $1,000 into XMD. This is assuming you're starting from zero. You don't already have a built portfolio. This absolutely will not work if you just start from scratch and hope it works out. You have to have something in place first. So basically, I take the $1,000, I buy $1,000 worth of XMD, and now I can borrow $800 against it. So I have my $1,000 working. If my bills for the month are $800, I would borrow the $800. In this scenario, you'd be pretty much margin called if XMD dropped anything. But basically that's how it works. I have an established portfolio already. I deposit 1,000, I can borrow 800. If I only need 500, I borrow 500. And that gives me the buffer back. And then we'll also assume that XMD pays monthly dividends. So then that would start chipping away at the interest. Sorry if I'm rambling a little bit, but that's basically what works in
Yeah,
my head.
interesting strategy. Yeah, interesting strategy, and it's interesting that, of course, it's from how I've seen it as well, Jamie. You have obviously you've evolved quite a bit over time, and it seemed like you've landed on what right now seems to be working well for you. You have a good grasp on it, and of course, as investors, we always stay on top of our portfolios, right? So we see how is it working right now? Do you need to course correct? Do you need to adjust? Or do you need to kind of double down on it because it's actually working exactly as you're intending? And I'm appreciative of the fact that you do share a lot of these updates on Blossom as well. So for folks who haven't followed you on Blossom, you can definitely check out Jamie's post on Blossom where he talks about specifically around the variety of things that some of them we didn't even touch on today, but for the interest of time, we might probably just bring people to Blossom to check out on some of those things. For example, the Wealthsimples has this building almost your index, and I think you've talked about that a little bit there, how you're borrowing and investing. All of that, I think, would be super fantastic. Thank you so much, Jamie, for your time today. I really appreciate it. I know you went on an interview earlier on with Ari, but it was a while back, so I thought, I think at the time you didn't have equity at all in your portfolio, and since then, I think quite a bit of involvement. So that really triggered me. It was like, oh, I'm going to reach out, see if you'll be open to coming on the show and sharing an update of where your portfolio is at, how you're approaching things. And for those folks who may not have seen your past interview, at least there's a good chance for them to get to know you here on YouTube as well as on Blossom. I appreciate your time. Thank you so much for accepting my invite.
I do have the part that will blow your user's mind if you have a couple more minutes.
Oh, yes. Let's talk about
All
that.
right. So since I'm really, really comfortable with debt, it doesn't really bother me at all. So I can tell some people if they are comfortable with debt, how they can earn money from their everyday purchases. So basically, I get a 10% ROI just by buying groceries. And the way I do it is simply this. I was fortunate enough to have a high income job. So I would apply for World Elite MasterCards, which pay the highest rewards. And then I'm very structured in where I buy things. So, and because of my previous being into debt history, I was a master of circular financing. All that debt I had, I didn't really even pay any interest on it because I was just paying credit cards with other credit cards and other credit cards and other credit cards. And I did that for years until BMO finally caught up with me. And every time I'd make a payment, they'd reduce my limit, which is against the terms of service of most credit cards, by the way. So don't do that. So basically what I would do, I would get a World Elite MasterCard. I always buy my groceries at Real Canadian Superstore. So I would get the PC World Elite Insiders MasterCard. I would buy my groceries with the MasterCard and I would sign up for PC Optimum offers. And if you'll see them if you're part of that group, you go spend $300, get 30,000 points. That's $30. That's a 10% return if you buy $300 worth of groceries. And then if you pay with the World Elite MasterCard, you earn more points from that. So what I would do is I would apply for the card. I would go into the store. I would buy and I would also browse the store for stuff I need that they have points offers on anyway. And then if I end up doing groceries on the week that they're doing that 30,000 points for $300, I would absolutely make sure I spend $300. If I'm at like $295, I'm buying like $6 worth of chocolate bars.
Yeah, smart, actually. Yeah. That's being very frugal. I love that. Yeah, it's very smart, being on top of the bonuses and points.
So the points programs is where I shine. So that's what I do. I'll spend the $300, get the $30 in points. It's an unrealized return until I cash the points. I would go into the parking lot and I would go, well, simple, pay MasterCard. So I got the points from using the card. I got the points for buying the stuff. And then I don't have any interest on my credit card. It's just points turning. And I've got another, like I have a credit card for everything. If I shop at Canadian Tire, I use the Canadian Tire World Elite. And if I shop at my other favorite card is the Neo World Elite MasterCard. It gives me,
Oh, yeah. Cashbacks,
yeah.
right?
So if anybody is looking into cashback cards, this one is pretty dope. It's $129 a year fee. This is how I structure my life. So I'll actually pull out the exact numbers for your viewers. Just hold on a sec. All right. So basically it has like 3 tiers to it. If you're a fan of having an emergency account, if you park money into the Neo savings account, it'll increase your reward levels. To me, I don't have an emergency account. Everything's invested at all times. So my base earnings on this card, for gas, I get 3% cash back. For groceries, I get 5% cash back. For reoccurring bill payments, I get 4% cash back. So every time I pay my electric bill, it's linked to this MasterCard.
That's so cool.
I earn $4.58 every time I pay my electric bill with this MasterCard. And they also have partner rewards. So I always get my gas at Co-op. So their partner reward is that you'll get 1% cash back for every purchase made at Co-op. And then for every 2 purchases, you get another 1% cash back. And then it gets even better. If you sign up for a co-op account, like a Calgary Co-op membership, you also get 8 cents a liter cash back on your fuel.
That's really
so
nice.
With all these rewards stacked up, I'm making money as long as I don't pay interest on the credit card.
And these are the purchases that you're going to be spending on anyways, for the most part. Like, for example, groceries, we all have grocery bills we have to spend. It's just that you're being smart about it, right? You're planning ahead and then how you're using it wisely accordingly. You're being very deliberate of where you spend your money and how you spend it, right? You could go to any store, but you're just being, like in this case, it seems like you would probably gas up mostly in Co-op. Is that fair to say?
I always gas up at Co-op. I don't shop by gas prices. I shop by gas station. So I'm like, I'm running out of gas. Where's the nearest Co-op? So
that's very cool. That's very neat. Based on your own estimates, Jamie, so like, would you say, do you have a ballpark of like how much overall in a year maybe it has saved you in this regard, being smart about it?
Right. I'll get into a little bit more details. So since I work construction, our construction vehicles need fuel. So I fuel them at Co-op as well to get the 8 cents a liter cash back. Last year, I bought 27,000 liters worth of diesel. That wasn't even my money, and $458 in Co-op cash back from that.
Points, yeah. That's incredible, yeah.
So it's being...
That's very smart.
Being deliberate with where your money goes first. Like I have another one for one of my followers, Mr. White, who drives truck. If you're fortunate enough to have a Canadian Tire World Elite MasterCard and you can manage to get a petrol points card, petrol points are convertible to Canadian Tire money. So if he were to get a petrol points card and fuel up at a Petro every time he fuels his truck and pays with a Triangle Rewards MasterCard, he will get so many Canadian Tire points. It will be insane, I promise you.
That's incredible. I would love, Jamie, I mean, just an idea, because it seems like you have a lot of tips around this topic as well. And I don't think I've seen a lot of these type of posts on Blossom. So maybe if you're ever open to it, like maybe sharing some of these tips around personal finance, I think it would be really cool. And it's one of those ones that I wish more folks talk about it, because there are sometimes unique nuances and things that it's not very widely spoken. Like here and there, yeah, you hear it, but knowing about like practical experience of, okay, I have used it this way and this is how much it impacted me and whatnot, really eye-opening. It might trigger somebody else like, I'm gonna also start looking into it. Why not? So just an idea. I'm not sure if you've already shared that on Blossom, or if you did, at least I might have missed it. But really cool to hear a lot of these updates from you here on this YouTube.
I have not seen anything like that on Blossom. The most of the discourse I see on there is mostly people that are averse to debt. They don't want to have any debt. They never want to use any debt. So they don't talk about it. It's like it's taboo or something.
I think there's some community of folks that talking a little bit on margin, but probably like you're right. The mass majority are not as comfortable with that. But I think, I don't blame folks either, because I think it's just, we've all, me included, grown up learning from our parents, like, that is bad. Like, the last thing you want is just going more debt. Try to pay off your debt as fast as possible. So it comes with a different comfort level and also the level of knowledge and understanding. So it's not for everybody. But I think to your earlier comment, you said that one of the things about Blossom, which I think we are hoping we see more and more of, is that discourse, right? So like conversation, being open-minded and learning about it. It doesn't mean that necessarily just because you hear it, you have to go and implement it, but at least being aware of it. What is it that the other person is implementing it? What are some of their reasoning behind it and how they're approaching it, and then from there onwards we can learn from one another.
How would you buy a phone, Mo?
Phone, I usually, first of all, I don't buy phone as often, but what I do, I usually buy it. I mean, I'm in a fortunate spot. I buy it what do you call upright, pretty much. So I don't go in debt or anything like that for that. But I might be a bad example. So talk about the general public.
You're the example I want. So you would basically buy it cash, right?
Yes, by credit card, but yes.
All right, you would buy it by credit card? All
yeah.
Right. So if you have a points card, so basically what I would do is right now I would buy it with my credit card and get the cash back rewards, and then I would pay off the credit card. So I'd use a cash back card to buy the phone.
You're already buying it cheaper then, right? You're already getting a cash back as a result of that.
And then the advanced level of how I would buy a phone now is I would deposit the amount of money into my investment account, buy it with the credit card, and then take a margin loan to pay the credit card.
No, yeah, that's the pro level. That's I haven't gone that far.
Yeah, use the rewards card and then pay it off before you have to pay interest on the credit card. Yeah, that's basically.
I love these the various rewards cards, and I think I don't know how Canadians are overall in terms of using some of these rewards perks and whatnot, but I think as long as folks are responsible, I would say, with their spending, or at least have a game plan, properly well thought of game plan, then I think it's great to be able to take advantage of that, because a lot of times there's that sign up bonuses upfront, which is always very, very can be lucrative, especially for more of a higher end tier cards. But beyond that, like the example that you brought up, like for instance for Neo cards, right? There seems to be really, really interesting ones, like in terms of cashback, and particularly for the expenses that you're gonna have to spend money on anyways. That's just being smart and savvy about it. Jamie, it's been so wonderful having you here today. I really appreciate your time. Thank you so much for taking some time off of your weekend. I mean, for us to have to find this time for us to connect. Really appreciate that. I look forward to continuing to learn from you on Blossom and following your journey in there. Any final words before we wrap up?
No, I just have to say, just stay disciplined and make investing a bigger priority in your life, and you'll see great success with it. It doesn't really overall matter what you choose. If you choose an all-in-one index fund, they're all basically the same, whatever you like. There's lots of posts on it, so just choose something, but stick to the plan. The more you mess around with it, the worse it gets. So just stick with it, and happy investing, everybody.